Right, welcome to part 1 of lecture 10 for FMGT3224, where we are going to talk about organizational structure and performance measurement. This is a fairly short lecture and not a particularly dense topic, but still some useful information in here. So when we talk about organizational structure, one way to look at it is in terms of decision-making authority, and there's sort of two extremes, and most organizations fall somewhere in the middle. But really, it talks about decentralization of decision-making authority. So, a centralized organization is one where all the essential decisions are the impactful decisions are made in head office. And at the other end, decentralized is where decision-making authority is pushed down to the lowest reasonable level, which could even be frontline employees. So, for example, the ability to negotiate on price or offer a refund or something like that. Some places keep that quite highly controlled, others push it far down. Certainly, as you look at this across time, we went from a situation where decision-making was typically centralized. This sprung out of the Industrial Revolution, and when workers couldn't be trusted, kind of attitude, and probably carried on through into the 50s and 60s because you had a lot of people working who were veterans of World War II and who were used to a very centralized organization. But into the 90s and the 2000s, the idea of decentralizing authority for decision making began to take hold, and it began to spread. It's not suitable in all organizations, but you do see more and more of it today. Okay, why do we care? Well, if we decentralize, then it gets a little bit more difficult to assess the performance of these decentralized components of the organization. When everything's centralized, it's easy. You just measure the top guy because he's got all the decision-making authority, right? But as you decentralize, it gets more difficult. Now, some advantages to decentralization. In my experience, the two biggest that have the most impact, I think, is those two there. So lower level decisions often based on better information. In other words, the guy or gal at the coalface, the one who's dealing with the customer, if they're smart and well trained, has a pretty good sense of what the customer's need is, and if you give them the authority to make the decisions to meet that need, you're probably going to keep and satisfy that customer. If they have to wait for approval on something, for a chunk of time, customer satisfaction suffers. The other thing, though, is that smart employees, the kinds that you want to keep engaged, get a kick out of having decision-making authority typically. And so they tend to stick around in organizations that give them responsibility for longer. But there are some disadvantages to decentralization, and probably the biggest one. This is a bit trickier to kind of highlight, but I would point out these two. Often what you see when an organization moves from being centralized to decentralized, normally it's growing, and that's just sort of part of evolution. Sometimes you'll see organizations go the other way, and often that's when they're in crisis. So if you are hemorrhaging cash, in other words, your operations are not cash flow positive, then you will often see a centralizing a trend, because it is easier and more efficient to keep a grip on cash when spending decisions are made by a smaller number of people. It also prevents or just makes it harder to physically spend money if you have to get a whole bunch of approvals and so on. And that can help preserve cash too. It's not necessarily in the organization's, um, I was going to say long-term best interest, but survival is in its long-term best interest, and therefore sometimes centralizing is worthwhile. But get through the crisis, and then you can re-examine the potential benefits of decentralizing after that. Okay. So if you have a decentralized organization, it does get difficult to measure the performance of the managers with this decentralized decision-making authority. And so how do we typically do that? Well, what we do is we organize or we categorize these separate decision-making entities. We call them segments, as in different segments of the business. And we can classify them based on the kinds of responsibility that the decision maker associated with each, or the manager, has. We can talk about cost centers, profit centers, and investment centers. And we'll get into more detail on those in just a second here. So, a cost center. Essentially, the manager in charge of a cost center is responsible for keeping costs down. He or she has no influence whatsoever on sales, so they don't see any of the revenue side of the equation. They just focus on keeping, producing the right amount of stuff at, within appropriate quality tolerances for the least amount of money. So examples of a cost center, again, it could be a production factory, the accounting department, things like that. Kick it up a notch and you look at a profit center. That now is somewhere where, in addition to responsibility for costs, the manager in charge of a profit center also has responsibility for the revenue, and therefore they tend to be a bit more senior. So a profit manager may have a revenue center and a cost center below him or her. A revenue center is something like a sales department, right? Where really and a pure revenue center is rare, because normally there are costs involved in generating revenue as well. But normally a sales department is sort of the closest thing you come to a pure revenue center. So a profit center would supervise, potentially, a revenue center and one or more cost centers, typically. Now, if that's cost and profit, those are fairly self-explanatory. What the hell is an investment center? How does that work? So the distinction of an investment center is, in addition to being responsible for profit, the manager in charge of an investment center has the authority to spend money on capital decisions. And so buying property, plant, and equipment. So the assets, the investments in those assets that are used to generate the profits and so on. And normally that's at a level higher than your standard profit center, because in most businesses you're committing awfully large chunks of money in acquiring property, plant, and equipment. So that's your three main ones. Add in revenue center if you want for a fourth. Here are some examples of individuals who might be in charge of cost and profit centers. So looking at cost centers, a plant manager, warehouse manager, distribution manager, and some of these staff functions, the CFO, the legal counsel of a legal department, and so on. None of these guys generate revenue per se, they just save you money, right? Although, tell that to a plant manager, he may get offended, but at the end of the day, his or her job is to produce the product to acceptable standard at the lowest possible price. Kick it up a level here, and now you're looking at a profit center where they're managing a product line. So they're responsible for the sales of the product and the production or acquisition of that product. and then kick it up one more level, and possibly vice president of operations. Often investment decisions would be made by the CEO, and possibly even if the dollars are big enough, by the board of directors itself. So that gives you a bit of an idea of sort of how these things fit together in the hierarchy of a typical business. So how do we go about reporting the performance of these organizations? If you remember, going back to when we looked at relevant costs for decision making, one of the problems was we had these allocated common costs that made different divisions or segments look profitable, more or less profitable than they actually were, even though they were not avoidable costs. They were common costs that were allocated. So the way around that, which fits into our segment reporting here, or our performance measurement by segment here, is to do something called segment reporting. And that basically is you look at a contribution approach or contribution margin type income statement with each division reporting its contribution, and then the fixed costs that would normally be allocated out to each division are not. They're lumped together and kept as sort of a total corporate cost amount in a different column. And we'll take a look at what that looks like in our first brief exercise 12-12. All right, so here we've got exercise 12-2, or brief exercise 12-2. The Clinker Corporation's got 3 segments, North America, Europe, and Asia. Revenue for the segments was blah, blah, blah. Variable cost, 30% of sales. Fixed expenses for each segment, $270,000, $900,000, and $600,000 respectively. Common fixed expenses for the company amounted to $1,590,000 for the year. And then we are asked to prepare a segmented performance report for Clinker Corporation. Okay, so we've got the information we need here. We will look at North America, Europe, Asia, and total. And so we've got sales revenue, and we're told for North America was 1,200,000. Europe, 3,800,000. Asia, 800,000. Which gives us a total of 5,800,000. Okay, variable costs, and these are all 30% of sales. So this was 360,000, 1,140,000. 240 and 1,740,000. Contribution. Margin 840. 2,660,000. 560 and 4,060,000. Okay, now we've got what we'll call as segment fixed costs. Which I think we'll continue with in part 2 of the lecture.